Ladies and gentlemen, in this video, you'll grasp the art of comparing an investment's past performance. It's all about that almighty dollar return and the percentage return, the metrics that separate the winners from the losers. Understanding the essence of measuring change is the cornerstone of comprehending interest rates, deciphering financial reports, diving into statistical analysis, and gazing into the crystal ball of forecasting. All of this, my friends, lays the foundation for you to become a masterful trader and investor. You must grasp this topic with crystal clarity, for it is the bedrock upon which you'll build your mastery of advanced concepts. The formula notation you'll encounter here is your first step on the path to conquering the world of financial derivatives. Remember, in the world of finance, knowledge is power, and power is everything. So, pay attention, absorb, and let's make some money.
Hey, Sophia. I heard you're enrolled in that financial math class this semester. How's it been treating you?
Hi Daniel, it's been quite intense so far, but I'm managing. How about you? Is this your first time delving into financial math? I'm excited to go into it.
I've heard the time value of money can be a real brain teaser. Do you have any recommended resources or study techniques for tackling that?
Yes, I agree. The time value of money is indeed a fundamental concept. I found the Traders Cafe YouTube tutorial particularly helpful. They simplify complex financial math concepts, keeping in mind that we are going to be professional financiers. Here's an example that might give us some perspective about it. Let's assume that today's closing price of company ABC's stock was $11, and company XYZ's was $101. 1 month ago, ABC's price was $10, and XYZ was $100. Which of the two stocks do you think provided the highest return?
Well, one approach to answer this question is to calculate the price change for each company's stock. For ABC, it would be today's closing price of $11 minus its 1 month ago price of $10, resulting in a $1 change. And for XYZ, it would be today's closing price of $101 minus its 1 month ago price of $100, also resulting in a $1 change. So, did they provided the same return?
Well, it may be the same dollar return. However, this approach doesn't satisfy us because it doesn't account for the initial stock prices. We intuitively know there's more to it.
You're spot on. Just looking at the price change alone doesn't paint the whole picture. It doesn't consider the difference in the starting prices of the two stocks.
Let's break down this financial formula with the gusto of a Wall Street titan. The change, represented by the symbol delta, that's delta, for you newcomers, is the key to understanding how things evolve in the world of finance. It's all about keeping tabs on shifts in the financial landscape. Now, let's dive into the meat of this equation. On the left side, we have change, delta C, which signifies the alteration in something. It's what we're trying to figure out. It's our target. On the right side, there are two terms that contribute to this change: final price and initial price. So, what this formula tells us is quite simple. The change in something, delta C, is equal to the final price minus the initial price. In the world of finance, this tells you how much something has shifted, whether it's a stock price, asset value, or anything in the financial realm. In this formula, we've got some Greek symbolism, and we're talking dollars and dates. So, here's the scoop. Delta C subscript, T minus 0. This is our hero, the Greek letter delta, denoting change in a variable. It's like the chameleon of finance, telling us how things transform. C subscript T, or CT. Now, this is where the action happens. It's the closing price at the end of some period, and I'm talking cold market price. It's where the financial rubber meets the road. C subscript 0, or C0, on the other hand, this is where we started, the closing price at the beginning of the same period. It's the initial state of our micro-example financial universe. T. This is our T for time. It's the date value when our journey ends, The closing bell rings at the end of the last trading day of the period, and the financial saga is done. 0. This little guy is the date value when our financial adventure began, the dawn of this trading period. T-0 is the time period elapsed between 0 and T if T and 0 are dates. The time between can be measured in time units like years, months, days, hours, minutes, or tiny seconds. Now, what does this formula mean? It's simple, really. Delta C subscript, T-0, tells us the change in the closing price of some asset or security during a particular period. How do we get this change? We subtract where we ended, CT, from where we began, C0. It's like measuring the distance between the finish and the starting line of a race. The result is the financial transformation that occurred during that period, the ups, the downs, the money made or lost. This is the dollar return or dollar change formula. But, as Sophia, Daniel, and you are suspecting, its power is limited and doesn't take into account the basis, the difference between the initial prices of the two assets, as you are about to learn in our next chapter. In this video, you got a taste of the dollar return, its practicality and constraints. Next, we're diving into the world of percentage return, and it's going to blow your mind wide open. If you crave more of this gold, drop a comment, and you better hit that subscribe button. We're not here to hold your hand. Thanks for tuning in.